Hi, welcome back to the continuing lecture in investment analysis. Um, our topic today is actually, free cash flow model. But we were supposed to do the spreadsheet 13-2 exercise, right? So I showed you where to find that file and in our last video, so you should have downloaded it and have it ready in front of you. So this exercise, must be done during this session, right? Together with me. Let's take a look, right, at this file. So first, I don't know which company, but because there's no further, maybe Honda, because that was the data they used, in the previous example. But they have this forecast. I mean, 2018 forecast and 2014. We have, basically given data because we are time zero for us is 2014. So, and this is the end of the year, right? Always the data is, as of the end of the year. So we have, basic information, price earnings ratio. Well, you might wonder, why is that needed here? It will come in handy later. It will come in, there's a reason for that. Capital spending per share, that data, will it come in handy? We'll see. Long-term debt is like bond and mortgages, right? So whatever is in column C is given data. And then okay, these two, I don't know why I highlighted them, but there's no need for any highlight because they were already given, right? And everything that is highlighted, they were not given. They were actually forecast. On this one, I'm sorry, that shouldn't have been. This one shouldn't have been highlighted. This shouldn't have been highlighted. Okay, these two. All righty. And then number of shares, 10,000. So number of shares cannot go up and down, right? Remember, because it will have to be once it is issued, right? The shares, a fixed number of shares have been issued, and then that's through public offering, IPO, and then until the second public offering, right? There's no, company doesn't issue new shares, and they don't do it, every once in a while. They can't do it, and this was also explained in the Finance 100. Unless there is sufficient demand and the company is confident that they can sell X number of shares and they can get all sold in the market, they won't do that, because if they do that and if they don't get sold, there isn't enough demand and they don't get sold, then it only dilutes the existing share price. That will be detrimental to the investors, right? So otherwise, the company, the only reason other than the second public offering or private placement or subsequent public offerings, stock a number of shares don't go up or don't go up, and there are times number of shares would go down. Why? When company buys back the shares from the market, and the reason for this is to boost stock price. Okay, when company buys back the shares from the market, it's a demand, right? Demand always drives up the price. So for the sake of booing their stock price, sometimes they buy back stock repurchase, right? And during these, during the period, most last decade, as the interest rate has been, very low, right? The stock market was very good because of low interest rate. Some companies were even by borrowing money, they bought back they repurchased their stocks just to push up the stock price. Now, anyway, and that was also one of the reasons why the market was so good, because that's a buy demand, right? Now, anyway, so that's why the number of shares, remain constant over this, time horizon. Earnings per share. This will be also. This will come in. This will come in handy later on. Working capital. What is working capital? That's like current. It's actually net working. I believe this is actually net working capital, not just working capital, because working capital means current assets, right? But net working, actually, it should be net working capital. Otherwise, because net working capital is an important factor, right? That must be net working. Net working capital is an important factor in determining free cash flow. All right. So I've already, annotated everything because when we, if it is in draw, right? If it is in that feature, then when I try to look into the type in something or look into the cell, look for the formula, then it doesn't. It just interferes so much, right? Yes. So first of all, input data. Okay, and these are basically data already provided, right? Then these highlighted areas are the forecast, and you might wonder, how do they generate that forecast? This is, you saw this before. They just so let's take a look at this. What is that? C3, which is this. Plus one times, this one is not really necessary, but G3 minus C3. G3 is 2018 P ratio, right? And then you simply take the difference between the beginning point, start point, and the end point, and you divide it by 4. Right? So simple average. They use the simple average and just assign that simple average in year 1, and then year 2 times 2. I just don't like this to interfere. Times 2. Then you can tell what was the formula in here, times 3, right? Times 3. Now again, they use the same assumption here, right? What is D4 um, I mean, G4 minus D4, right? So this forecast was probably, obtained from some source like, valueline.com or Morningstar. So at least they made, 1 year forecast. So we used, because Morningstar or, Value Line, they are reliable data source. And then you simply take the simple average and distribute it over the period that we have blank for, and then we generate this. Also the same thing, right? It's sort of like smoothing out. Um, so they all follow the same rule, right? Here, that's simple average, So not very interesting. Uh, let's move on to the free flow forecast, because that's what we need, free cash flow, because this is free cash flow model. And then uh, we will need to find free cash flow to the firm, free cash flow to the equity holders, and so on, right? So first, again, these are, I shouldn't have, okay, initial data. So, oh, this one had, I'm sorry, and that didn't have to be, only this one. So these were given. This was also given, right? And then using also a simple average, you just smooth it out, right? And then interest, okay? This is interest payment, right? Now, remember, free cash flow to the firm is basically EBIT times 1 minus tax rate. So that's EBIT minus tax, right? Um, plus depreciation, right? EBIT minus tax is basically what? Uh, EBIT including, EBI, I mean, if you remember from, uh, uh, from our last lecture, like, and the and from the slide, right? We all know. So interest calculation is not that difficult, right? We have some, all those, tax rates and, interest rates, discount rates, those data points, those data are here, right? The ratio data, rates and ratios, So B25, of course, that would be the long-term debt, right? There you go, B25 long-term debt, and 1 minus tax rate times C5. And C5 is long-term debt. B25, what was B20? Oh, the tax rate. I mean, the interest rate. B25 is the interest rate. How do you know? It says return on debt. Return on debt is what? Cost of debt, which is interest rate, right? Um, so times 1 minus tax rate times the long-term debt, and it's just the rest of it is, following the same. Uh, a B25 is locked, because as you copy and paste it across, right? By locking B25, because it shouldn't change, because if you don't lock it, um, as you copy and paste across, this cell will also uh, move, right? Because it will adapt to the new uh, target cell. So the reference cell will also move along with the target cell. So I mean the solution cell. So it will be pointing to C25, and obviously that's a nonsense, right? So you lock that, and then you uh, just drag across, and that's how they found the interest, right? And then change in working capital. You won't have any data. You don't have this data for 2014. Let me do this because this will. If I freeze pane, then okay, the labels will still be there, as I scroll down or left to right. Okay. But think about it. Change in working capital. Um, to have this data in 2014, the data should start from 2013, right? Because changes, yearly. It will be 2014 minus 2013 to have the data here. But that's why we have data only from here, which is simply uh, uh, that's not the one. I'm sorry. Change in working capital, right? Simply this minus this, and then this will be this minus this, right? Yes, and you uh, just drag it across. Okay. Now, depreciation. First 2 years it was given, right? And then last year I believe it is given, right? Uh, and again, simple average technique. You just allocate it. Capital spending. Now, what is capital spending? Uh, Total capital spending, in other words, that's because capital spending per share. Capital spending means capital expenditure, right? Per share is $1.40, or 10,000 shares, so that times that, right? 14,000, and that times that, right? The same thing, right? And uh, uh, interestingly, they didn't actually tie it together with this, uh, but what they did is, because um, first year and last year we have that, and during the intervening years, they simply took the simple average and allocated it. Let me see if it's going to be very different, significantly different, if we use the formula. Okay. For example, that was this times. Okay. And if you put it into dollars, right? It isn't that different, right? And it isn't that different, right? Yeah, we still get the same thing, right? We still get the same thing. So it's not that different, right? Either way, we would have got the same result. Um, so we got all this data. Now let's capital because this is Why did we do that? Because that's CAPEX. Capital expenditure. Capital expense, or it's the same thing, but I'm gonna write it as CAPEX because that's another way of writing it, another acronym, CAPEX. So we are ready to calculate, we're ready to calculate it. So first of all, if this profit is after tax, right? Does that mean? I mean, normally, profit after tax is EAT or net profit, right? Uh, but to calculate free cash flow, what you need is EBI, right? Think about it. From EBIT, if it is after tax, right? Then it should be EBI. So is it EAT? They are talking. Is that EAT in ordinary sense of the word? After tax profit is EAT, or is it this? Because EAT is not EAT is irrelevant in this case, right? And we'll see. So we have oh, my Excel is stuck. It's not. Let me at least. Oh, yeah. What's happening? What's happening to my Excel? Oh, it's completely gone. I was putting too many things. I guess it froze up. But let me. It doesn't say it's. I'm looking into a task manager and. My God. This is an accident, right? I should have kept saving. The memory is. Oh God, I think it is. The memory is full. I mean, the RAM is full, so it's not going to be freed up anytime soon. Once the RAM gets down to uh, low, reasonable level, then I don't think it's possible to recover the Excel file. So I guess I will have to cut the video short here. I mean, about 5 minutes. The video will be just about 5 minutes shorter. But let me, um, yeah. Uh, so instead, let me go back to, let me stop sharing and uh, go back to, yeah. Okay, so yeah, this was the slide that we were discussing last time. So in this Excel exercise, we're going to be doing doing both models. I mean, it's the same model, but one uh, we're going to find, we're going to calculate um, free cash flow to the firm, and we're going to calculate free cash flow to the equity holders. And they can be done, in with a single a model. I mean, because we have basically it's sharing the same data. And one thing we have to uh, uh, clearly understand is, this was also explained last time. Why is interest payment, I mean, one minus tax rate is effectively reducing the interest payment. And then I told you this is the tax break from the nature of the uh, interest payment, which is business expense because it's before tax, right? It's tax deductible. It's subtracted before. But then you might wonder, yeah, but if the tax rate, suppose, think about it, if the interest rate is 10%, right? If the interest rate is 10%, and if your debt is uh, 1 million, I mean, aren't you still paying 10% of 1 million, which is 100,000, which is, 100K. I mean, you're still paying, 10% interest payment. Where's the savings? Where's the tax break? No, tax break comes from reduced taxes. In other words, um, eventually, to this interest, right, which was 10%, right? Uh, let me, to this interest rate, which was 10%, right? Your and suppose your tax rate is 30%, right? Because the EBT taxable income is lowered by as much as the interest, right? Interest payment. Effectively, by paying smaller taxes, right? By paying smaller taxes, what you paid, uh, the whole 10%, the whole 10% that you paid here is actually benefiting, is actually going down. I mean, the tax savings comes from smaller taxes, right? Paying smaller taxes. So actually, uh, the effective interest rate that you're paying will be what then? It will be 7%. Isn't that right? It will be 7% because after um, that 30% tax that basically, you would have, if there was no uh, interest, that means if there was no debt, then there would be no interest payment, right? And then you would have paid anyway the uh, uh, entire EBIT will be taxable, right? Entire EBIT will be taxable. That if the entire EBIT is taxable, then you would have paid more taxes. But by having that interest deducted, right? EBT gets by paying that, EBT gets smaller, so you save on tax. That saving comes saving offsets, right? In a way, not it doesn't offset exactly, but partially cancels out, right? It cancels out 3% of this, interest rate. Okay, that's the idea behind it. All righty, we'll have to stop here now because I thought um, this model takes so much time, and the Excel file suddenly froze up. So we're gonna continue with the rest of the model Excel exercise, next time. Okay. Uh, Thank you for joining, and stop recording.